Okay. All right. Welcome back, everyone. We're now going to kick off our first research discussion of the day. And we've already had a lot of discussion about some of the topics that will be covered here. Some of the biggest challenges and opportunities in the fintech stem from the use of technology to gather so-called alternative data. At home, at work, in our pockets, we're surrounded with data-generating technology. But the questions are, what could this and other data play in a bank's core function of providing credit? So our next 5 panelists will grapple with this question by discussing the positive and negative ways data and technology can influence who obtains credit. The discussion will be led by Robin Prager, Senior Advisor in the Division of Research and Statistics at the Federal Reserve Board. Robin has conducted research and is an expert on issues surrounding the availability of credit in the role of community banks in the U.S. financial system. So please join me in welcoming Robin and the rest of the panel.
Thanks, Diane. And I want to thank the organizers for inviting me to participate in this really exciting event. It's a pleasure to have the opportunity to chair this panel on the topic of data and technology in lending. So fintech lending has been growing at a very rapid rate and now accounts for a substantial share of unsecured personal loans and rapidly growing but smaller shares of small business loans and mortgage loans in the United States. According to TransUnion, as of year-end 2018, fintech companies accounted for nearly 40% of all outstanding balances on unsecured personal loans in the U.S., and that was up from only 5% in 2013. The Federal Reserve Bank's 2018 Small Business Credit Survey, which just issued its first report, they issue several reports over the course of the year based on this survey, and their first report, which looks at employer firms, found that nearly 1/3 of their firms who had applied for credit over the last 12 months had applied to an online lender. And in the mortgage space, there was a recent NBER working paper that was authored by researchers at the Federal Reserve Bank of New York and NYU that found that the fintech share of mortgage lending had quadrupled from 2% to 8% between 2010 and 2016. So I think it's fair to say that fintech lending has now reached a scale where we as policymakers really need to be thinking seriously about its implications. Fintech lending, as I'm sure all of you know, differs from conventional lending in that it relies on technologies and, in some cases, types of data that have not been part of the traditional underwriting process. And among the many benefits that have been attributed to fintech lending, perhaps the most prominent is the ability to provide quicker, more convenient access to credit for loan applicants. However, the introduction of new technology and new data to the underwriting process can also have some downside effects, and it can change the mix of people who are able to gain access to credit, and that can be good or bad. It can allow people with thin credit files who were not previously able to access credit to be able to get loans, but it can also potentially facilitate forms of discrimination that we haven't seen before, and it can reduce the transparency of the lending process. So in this session, we're going to hear from the authors of 3 very interesting papers that shed light on how fintech lending affects who is able to obtain credit and at what price. Following their presentations, we will hear from our policy discussant who will give her perspective on the research findings, and then there will be plenty of time, I hope, for audience Q&A. So just to give a brief introduction to all at once all of the papers and presenters. The first paper is by Manju, Puri, and co-authors, and considers the value of consumers' digital footprints, that is, the information that they unknowingly leave behind when they engage in everyday online activities, for predicting the probability that they will default on a loan. Manju Puri is the J.B. Fuqua Professor at the Fuqua School of Business at Duke University and a Senior Advisor at the Center for Financial Research at the FDIC. Her expertise is in the area of empirical corporate finance and financial intermediation, with a focus on commercial banks, investment banks, venture capital, entrepreneurship, and fintech. The second paper will be presented by Richard Stanton, and he co-authored this with some of his colleagues at UC Berkeley. And this paper examines the effects of algorithmic lending by both fintech firms and conventional lenders on discrimination against minorities in mortgage lending. Richard Stanton is the Kingsford Capital Management Chair in Business and Professor of Finance and Real Estate at the Haas School of Business at UC Berkeley. His primary research and teaching interests are mortgage markets, term structure modeling, mutual funds and risk management, and employee stock options. The third paper is by Huang and co-authors, and it looks at big tech involvement in the provision of credit to micro, small, and medium-sized businesses. Huang is an associate professor of international economics and Pictet chair in finance and development at the Graduate Institute of International and Development Studies. His recent work has focused on credit markets, household finance, fintech, and entrepreneurship. Following the presentations by the three authors, we will hear from our policy discussant, Melissa Koide. Melissa Koide is the CEO of FinRegLab, a new organization that leverages technology solutions to achieve public policy aspirations, address regulatory goals, and drive the financial sector towards an inclusive financial marketplace. Prior to establishing FinRegLab, she served as Deputy Assistant Secretary for Consumer Policy at the U.S. Treasury. So with that as way of introduction, I will now turn things over to Manju Puri.
Okay, so this paper is on credit scoring through digital footprints, and the motivation for this paper is very straightforward. Most of us in this day and age are aware that if we leave information on Facebook or we tweet a lot, that information is readily available to everyone, and it tells people a lot about us. But on a regular basis, almost all of us surf the web and register on websites. How much information does this simple act leave behind, and how valuable is it in actually predicting default? And that's what we're going to look at in this paper, and this has wide implications from a variety of perspectives for the business models of financial intermediaries, right? And think of banks and how they traditionally do lending and the information they use. Should you co-opt this kind of technology or not? And then earlier in the morning, we heard about access to credit for the unbanked, how that's a major source of worry for regulators around the globe. And so it has potential there. And then last but not least, how should consumers, firms, and regulators behave in the digital sphere? So here's a picture that helped motivates this. So what is this picture about? This is publicly available information, and it simply captures the operating system that you used. And so if I was a man or a woman from Mars and I know nothing about the US, this is actually New York City. And you can see the red dots here, right, are essentially if you're using an iOS system. And so that is if you're using an iPad or an iPhone. The green dots are if you're using Android. And the purple dots are if you're using a BlackBerry. Right? And so what you can see here, exactly, where are all the red dots concentrated? That's the borough of Manhattan. Right? So if I know nothing about New York, I came from Mars, I can still tell you where the wealth is, simply by looking at this map. There's interesting research that looks at what's the difference between the rich and poor over the decades. Once upon a time, it was cable TV, BMW. In today's world, it's do you have an iPhone or an iPad? That puts you in the top quartile of income earners. And so knowing nothing about Manhattan, simply by this, I can tell you where the wealth is concentrated. Hey, it's in Manhattan here. Once I start going out to New Jersey and Brooklyn, a lot more greens. And of course, in the middle of the sea of red dots are a few purple dots. Who are they? Think of Obama, who refuses to give up his BlackBerry. Or think of bank-issued BlackBerries in the heart of Manhattan. That's what this is reflecting. And this is a single variable of your digital footprint. Anytime you access anything, people know this variable, right? And so think about how much more information you leave behind. And so in this paper, we are going to use a very shallow digital footprint, 10 simple variables that you leave behind when you access and register on a website. So let me just go to, I've divided these into 3 broad buckets. So the first bucket is, how do I get there? What's the device type? Is it a tablet? Is it a PC? Is it a mobile? The operating system, is it iOS or Android? And the email provider. Is it Gmail, Yahoo, or this data actually comes from Germany, and in Germany there's something called T-Online. You actually have to pay for it, right? And so you can think of these as being a crude proxy for income. I need a certain income level to buy an iPhone or to get a paid email address as opposed to a free one. The next 4 variables relate to, when I go to the website, how do I get there? Am I clicking on paid ads, or do I actually put the website address in? There's a big literature in marketing that talks about impulse shopping and all. And so the guys who click on paid ads, what do you think? The default rate is higher or lower? It's higher, right? And this is validated in the data. Checkout time. What time of the day do you access the website? Morning, noon, or night? When do you think default rates are highest? People who shop between midnight and 6 a.m. Default rates are highest, right? Privacy do not track setting. Email error. If you put your email in and it bounces, right, your default rate is sky high, right? So either you stole the email so you can't spell it right, or you're so drunk you don't know what you're typing. Either way, that's what happens. Then, do you have your name in your email address, right? So there's a burgeoning literature in entrepreneurship that suggests if I name my company after myself, it means something. If I own my email address, so I have my first or last name there, it means something. As opposed to if I put Sunflower 007, default rate is higher for Sunflower 007, right? Then finally, do you do what civilized people do, which is capitalize, the street and the thing, or do you type everything in lowercase? People who type everything in lowercase, default rate is higher. Okay, so here's a picture, right? And a picture sort of captures 1,000 words. So here we have the credit bureau scores. So the credit bureau scores, the good news is if you look at, the default rate on the credit bureau scores, the highest decile here as compared to the lowest decile, there's significant variation. So this is good news for the credit bureau scores, that they provide good discriminatory ability in telling you default. But now, if I combine 2 simple variables, Mac and a paid email, which is T-Online, as opposed to Android or Hotmail or Yahoo, now the prediction of the default rates there, the variation is higher than the difference between the top and the bottom quartile in credit bureau scores. And this is just 2 variables, right? So let's see what my 10 variables together are going to do. And again, I emphasize this is a shallow digital footprint. We're not asking about social network, your income, your religious beliefs, or anything else. This is just information you leave behind by accessing and registering on a website. Okay, so now we're going to see what is the predictive power of the digital footprint. So if it's random, it'll be 50-50, right? And so the 45-degree line is 50-50. If you have some information, so you can see here, the bottom 25% is predicting 65% of the defaults. So what is a good number? The literature suggests a good number is between 60 and 70%. Area under the curve, so that's what we're going to look at. And if we look at how much does the credit bureau score tell you, or predict, the area under the curve is 68.3%. This is good news for the credit bureau scores. Between 60 to 70% is informative. But now if I just use my digital footprint, just those 10 variables that I showed you, I actually get a score that is as good as the credit bureau scores. It's actually 69.6%. Now think of all the information a credit bureau score has, right? It tracks all your past loans, the repayments, your credit lines. Think of the staff, think of the time. Think of what it took me for the digital footprint. No time at all, right? Now, when you add the two together, the digital footprint and the credit bureau score, you actually do better. You get 73.6%. So you add another 5.5%, which suggests the digital footprint is a complement as opposed to a substitute for the credit bureau score, right? And so what we find is the digital footprint works well in predicting default for these short-term consumer loans. What about traditional mortgages or other things? So what we don't have data on that, but what we can do is ask, does the digital footprint predict your future credit rating? And the answer is yes, right? Your credit bureau score captures your history. The digital footprint captures you as you are today. So if you had a good history, but you lost your job today, you fall into depression, you start clicking on paid ads and shopping at 2 a.m., your digital footprint is going to capture it. It's going to take time to get captured in the credit bureau score. Okay, so the website that we're looking at, which is the e-commerce website, once they introduce the digital footprint, you can see in this picture, boom, the default rates go down. And so the digital footprint really economically helped prevent default. Then let's talk about access to credit for the unbanked. 1/3 of the people in the world do not have credit bureau scores. So how do you give them credit if they don't have a credit history? Can the digital footprint help? And again, we heard dialogue in the morning saying there's a lot of hope pinned on this. So we can actually test this in our data. 6% of our sample do not have credit bureau scores, but were extended loans. And so we look at them, and what we find is the digital footprint works as well, in fact, even better for these unscorable people who do not have credit bureau scores, than for the people who have them. The area under the curve is actually 72.2% as compared to people who have credit bureau scores, where it's about 69.6%. And so this gives us hope that the digital footprint, even if you don't have a credit history, we can use the digital footprint in giving credit to these people. Okay, now the next question, of course, is, in economics, we call this the Lucas critique. Once everyone knows this, won't they start trying to game the system? And it's just like in the old days when you would go to get a bank loan, you would try to impress the lending officer, so you'd wear a suit, you'd have a bath, unless you're Mark Zuckerberg, you won't go in your pajamas, but you'll actually try and impress the loan officer that you're a person of character and you'll repay. In today's world, does that mean whenever we go online, we wear a digital suit, right, in order to protect our digital reputation? If we do that, then we're changing our behavior first order when we go online. That in itself is a big deal. But second, not everyone might be able to do it, right? So first, buying an iPhone costs a lot of money these days. People who are jobless may not be able to do that. Second, some of our digital footprint captures behavior, right? And how easy is it to change behavior? Well, we all know how to be thin and slim and healthy, right? Eat well and exercise. Half of America is overweight, right? And so similarly, we might know the digital footprint, but you could argue the people who need the most help, the addicts who cannot help themselves, who pull out their mobile at 2 a.m. and click on paid ads, these are the ones who perhaps are going to have the most difficulty actually changing their behavior. Some things you can change. Now, Hotmail and Yahoo accounts, default rates are higher, much higher than Gmail accounts. And there's a study done in the UK that shows Hotmail account users would charge higher car insurance premium because, hey, they had more accidents. So, yeah, that you can change by shifting to Gmail. But other things like refraining from pulling out your mobile, refraining from clicking that link, refraining from, at 2 a.m. saying, no, I'm not going to go on the mobile, I'll have a glass of milk instead. That might be a little more difficult. Now, the other question, of course, is beyond consumer behavior. What about firms? Does this raise the potential for discrimination by firms? And again, it could be in a good way, it could be in a bad way. The paper following mine will have a little bit to say about that. And of course, for regulators, is this going to violate Fair Lending Act? There are all kinds of issues that come up once you start using the digital footprint, and many of these have to be thought through very, very carefully, right? And so what we looked at here is, a very shallow digital footprint, a bare bones footprint that you leave behind simply by accessing the web. We're not looking at a deep digital footprint that many companies are now employing, right? Where they either use your social network, or you have companies like Tala that will ask you, turn over all your mobile phone information to us, and they find people who call their mother every week, they default less, or people who have more than 100 connections, they default. We're not even looking. So that obviously gives you a lot more information. This is just a shallow digital footprint. Anyone who owns a website can harvest this information. So we're not even going into, is it Google or Facebook giving me this data? If I have a website, I can access this information, right? And so what we find is this digital footprint works as well as a credit bureau score in predicting default. We find it is a complement as opposed to a substitute. You actually do better when you put the two together. And importantly, it works at least equally well for people who do not even have credit bureau scores. And so, that raises a lot of hope in terms of giving access to credit to those who are denied it. This has potentially very wide implications. What should our business model be for banks, for how we do traditional lending or new lending, for people who can't get access to credit, and importantly, how should we behave as consumers? Do we put on our digital armor? How should we behave as firms? And how should we think about these as regulators, given the importance of the digital footprint? Thank you.
All right, thank you very much. It's a pleasure to be here. It's a great conference. See you. There we go. Okay, so this is a quick summary of some work that I've been doing with three of my colleagues at UC Berkeley, Bobby Bartlett, who is at the law school, Adair Morse, myself, and Nancy Wallace, who are all at the Haas School of Business. And the question we're trying to address is about discrimination in the era of fintech. So there's lots of words, but the basic story is really very, very simple. We want to look at how the advent of fintech lending has affected mortgage discrimination in the US. That's basically it. And if you look at Latino and African American ethnic groups, between them, they hold about 2.25 trillion of the total 13 trillion US household debt. So there's an enormous amount of debt out there. And what that means in particular is that even small amounts of interest rate discrimination are going to be material. So if you just sort of do a couple of multiplications, one basis point or 1/100% difference in the mortgage rate translates into minority borrowers paying about $160 million in total extra interest every year. So even little numbers add up a lot when the market is this big. And we also are interested in rejection rates. So there's two possible places where discrimination could occur. One is in the interest rate charged. One is in whether the loan is granted or not. So rejection rates also can be very material. If you look at the home ownership rates, they're very different between minority and non-minority borrower groups. If any of that is caused by differential rejection rates on mortgage applications, that's going to be having quite a significant impact on the welfare of minorities versus non-minorities. So it's a big question. What is our goal? Well, we'd like to estimate discrimination. Well, we'd like to first of all test, is there discrimination? And second, we'd like to estimate how big it is, and we'd also like to understand who is doing it. And in particular, what does the advent of fintech mean for discrimination? And this is becoming particularly important. We had a couple of statistics about the total number of loans issued by fintech lenders now. But if you look at it, Quicken, for example, now claims it's the largest GSE counterparty by volume. It's a fintech lender. So these are becoming very, very large portion of the market. It's not completely clear before you begin this project what the impact is going to be. You could imagine it going in really either way, or at least we could. Maybe you probably have other ideas too. But number one, to the extent that some of the discrimination that is going on is caused by face-to-face biases when a loan officer and a potential borrower get together, presumably doing everything online where that interaction doesn't occur, that's going to be helpful and potentially reduce discrimination. On the other hand, these online lenders are typically using more variables in a more sophisticated manner than the face-to-face lenders were doing in the first place. And it's conceivable that that could result in more discrimination. The basic idea is, well, we know we're not allowed to use race as one of the variables that determines whether or not we make a loan. It's conceivable that if you give a couple of dozen 25-year-old computer science PhD students 250 pieces of data, none of which is individually called race, and ask them to find all sorts of combinations of those data, it's conceivable that they could find a combination of those data that almost perfectly reconstructs race, even though none of the variables actually had that name. And so you could imagine it leading to more discrimination rather than less, even though it might well be completely inadvertent. The other issue is to get at the legal standard of proof in discrimination cases. How does a court distinguish between legitimate and illegitimate discrimination? And that the idea is that in the courts there are basically two kinds of discrimination. There is disparate treatment, which is sort of the easy kind. It's like you look at the rule, and if it says minority borrower don't make a loan, that's disparate treatment. That one's kind of easy because you actually look at the rule and it says what it does. But there's also disparate impact, which is the slightly more subtle version. And with disparate impact, the idea is that your lending rule doesn't in any way explicitly talk about any protected characteristic, race, sex, whatever it may be. But it happens to have more of an impact on certain groups than on others. That is also illegal. Subject to the fact that the person using those characteristics, if they can claim that there was a legitimate business necessity for using those variables, then they're okay. Well, I'll talk a little bit more about that. So I basically think what we do is we estimate the level of discrimination, or racial and ethnic discrimination, if there is any, and by whom. And we use mortgage data really for two big reasons. First of all, it's big, but also a very important point is that in general, understanding whether there is discrimination or not is really very hard to do. So suppose I tell you that minority borrowers are 10% more likely to be rejected than non-minority borrowers. That at first sight looks like a bad thing. On the other hand, maybe the borrowers we're looking at are just different. They have different characteristics. And what you end up with is something called this omitted variable problem, which is that even if you have lots and lots of variables, if the lenders are using variables that you as the economist don't have access to, conceivably they are doing everything completely fairly. It's just that when you come to look at it afterwards, you don't see all the variables they use. In this study, it turns out that the way that credit risk pricing is done by Fannie Mae and Freddie Mac, it turns out that allows us to look at this in a way that avoids this problem completely. So that's kind of a big contribution of what we're doing here. So the legal standard, there are basically two US federal statutes that prohibit discrimination in mortgage lending. There's the Fair Housing Act of 1968. I'm sure many of you were at the 50th birthday party of the Fair Housing Act last year. Also the Equal Credit Opportunity Act of 1974. So these statutes are out there. And the question is, how do the courts interpret them? And we're mostly going to be thinking about disparate impact rather than disparate treatment, which is kind of just easier to prove. And the courts have ruled essentially that, just think about a model in which wealth, in any reasonable economic model of borrowing or lending, wealth is going to be an important factor that determines whether you're more or less likely to be able to pay off your loan. But suppose for some reason we can't perfectly observe wealth. We can observe some bits of it, but not perfectly. Well, then maybe we could use other variables as a proxy for wealth. And the courts have said, yeah, basically proxy variables are allowable as long as they give you information about the variable that you're interested in. And if you can show that these variables have a legitimate business necessity, which is basically, is it related to scoring credit risk? What they're not allowable for is other purposes. In particular, they're not allowable for earning sort of higher markup above cost on a particular minority group versus other groups of borrowers. And an example there would be, for example, the high school that a potential borrower went to. It's quite likely that the high school is going to be correlated with the wealth of that borrower. That would make it something that would be, at least at first sight, a reasonable variable as a proxy for income. But at the same time, the high school you go to is also related to probably where you grew up, and it probably tells you something also very much about the racial or ethnic makeup of the borrower over and above what it can tell you about the credit risk of that borrower. And so that's essentially the proxy. Anyway, so let's just look at how this works. We're going to start by looking at the interest rate charged on a given loan, conditional on a loan being taken out. And you don't have to read every word on this slide, but the basic idea is that the way that we okay, there is a red dot there, but it's so faint that I can't see it. The blue bar there represents the general market level of interest rates. That's common across everybody. Then on top of that, there is what's called a G fee. These are loans that are securitized by Fannie Mae and Freddie Mac. They charge an additional fee to provide a guarantee against default on these mortgages. And then over and above that, the lender can charge some discretionary amount, but that discretionary amount can't be different for different racial groups. The key thing, and this one you really don't have to read every bit of, is that the way the G fees are set by Fannie Mae and Freddie Mac is that they're set based on two variables which are completely observable. There is the credit score of the borrower down the side here, and there is the loan-to-value ratio of the loan at the top here, and that tells you essentially how much Fannie and Freddie charge you to protect you, to guarantee you against credit risk on that loan. And again, the key thing is that they charge you an amount that's based only on these two observable variables. Well, if I'm a lender and I'm going to be selling my loan on to Fannie Mae or Freddie Mac, then those are and basically the price that they're willing to pay for them depends only on these two variables. I don't need to use any other variables for pricing credit risk because I already know how much I'm going to be selling the loan for. Even further than that, suppose I think Fannie Mae and Freddie Mac are completely wrong and they're pricing these loans wrongly, and the other variables are really, really important in determining the credit risk of a loan. I still shouldn't use those variables because Fannie and Freddie are buying these loans for me, and the price that they're going to buy them for only depends on those two variables. So this allows us very cleanly to look at discrimination versus non-discrimination in that prices should basically only depend on those two variables. Just to give you an idea for how important those boxes are, this is the spread in interest rates across our entire sample, and this is what it looks like once you condition on what box you happen to be in. It reduces the spread enormously. All right, okay, we don't have that much time, so I'll go through this fairly quickly. This, in terms of what we did in the paper, this is a big part of the work. It's actually just getting the data to allow you to do the analysis. We've already heard mention of HMDA this morning. HMDA is basically the one data set that contains the race and ethnicity of the borrower, but there's a lot of stuff that's not in HMDA. So you don't really know the address, you don't really know the details of the loan, you don't really know the details of the loan performance. And for that, we had to merge a ton of other stuff. Took a long time, but I won't talk about it anymore because the cards are coming. All right. Oh, okay. So I won't go through the regression tables, but basically what we did is we regressed whether you are a Latino or African American borrower. Sorry, we regressed the interest rate on various characteristics, and what we find is that if you look at the top left number, 0.000903, what does that mean? It tells you that minority borrowers, on average, pay 9 basis points more than non-minority borrowers when they take out a purchase loan, and over there about 3 basis points more on a refinance loan. That's not conditioning on anything else, that's just the average. Now, when you condition on where in the grid you are and the year and the month, in case there are sort of time effects, that's still there. There's still nearly 8 basis points of difference between the rates charged to minority versus non-minority borrowers. And what does that translate? Does that matter? Well, yes, it does matter. In particular, when you compare those numbers with the average profit of about 50 basis points that a lender makes on a loan, it's certainly a very material portion of the profit made on that loan. Or if you aggregate what that means in terms of the total amount of extra interest paid by minorities in any given year, it translates into about $750 million in extra interest being paid by minority borrowers because of these differences. If you look at fintechs, so what we did was we compared fintechs with small lenders. What we find is that the fintech borrowers do discriminate almost as much as the non-fintech borrowers. I'll go through this fairly quickly, but that was a slightly disappointing result. However, one possibility is that what's going on is that the costs could be different. We're only looking at the rates, but of course they may not be allowed to charge. They may conceivably the courts might allow a lender to charge different amounts if their costs are very different. So maybe different lenders have different costs. Maybe different areas have different costs. And what we find is that when we look at that, the answer is no. That doesn't explain much of it. If you look over here, the results that you care of the 7.9 basis points that we find overall as the total difference between the two once you've conditioned on the LTV and FICO. Even when you put in controls for the lender and controls for the geography, it only reduces it to about 5 basis points. So nearly all of that discrimination is robust to where you are, what the identity of the lender is. Okay, various. Forget it. No, another day. The good news for fintechs. Here is the first piece of good news. Even though the discrimination among fintechs and non-fintechs is at least approximately the same, one thing that we found is this just basically shows the amount of discrimination over time. So these are loans issued between 2008 and 2009 and so on. So these are 2-year buckets. And what we see is a substantial decline overall in the amount of discrimination in the marketplace as fintech borrowers have come in and taken a greater market share. And so, even though they may not be discriminating any less, the greater competition and the greater ease of shopping around induced by the advent of fintech lenders, we think has actually led to less discrimination overall in the entire market. The other thing, and you don't really want to look at this one yet again, is that when you look at application rejection rates, it turns out that fintech lenders overall there is substantial discrimination. The blue number on the far right there, minority borrowers are about 6% more likely to be rejected than non-minority borrowers. But when you look at the fintech lenders, and we looked at 2 different definitions of fintech lenders, that number is substantially reduced and in many cases isn't even significantly different from 0. So in terms of the decision to make the loan versus not make the loan, the fintech lenders do seem to be actually discriminating quite a lot less than the non-fintech lenders. So just to conclude, our hope is that the work that we're doing could provide a tool for regulators and the courts to at least sort of throw around some ideas about how to define what exactly the hurdle should be for a disparate impact case. The numbers are significant, as I said earlier, in terms of the extra interest that's being paid by minority borrowers. It amounts to about $750 million a year. One interesting contribution, this whole thing that allowed us to do the identification, this sort of the grid put out by the GSEs, obviously the future role of the GSEs is a big topic of conversation right now. But one kind of surprise thing that we found was that in a way the GSEs could conceivably be playing, perhaps inadvertently, a significant role in reducing discrimination by the way that they price credit risk. And in future work in progress, our goal is, we think that a lot of what's probably going on is it's still geographical. It's related to the degree of competition in different areas. It may be related to the amount that different borrower groups are willing to shop around, and maybe lenders are able to take advantage of that differentially. And that's kind of where we'd like to go next. So thank you very much.
Thank you very much for the invitation and for the organizer, and especially for Manju. She invited me for this great conference. I tried to present one of my research in the past few years as a BIS fellows. Okay, thank you very much. Again, I'm Huang from Switzerland. In the past few years, as a BIS fellow, I traveled to Basel to working with a team chaired by Yong Xin, try to understand international evidence about fintech. It's very nice, good order after 2 presenters, mainly to talk about the lending side, default and the rejection rate, discriminations. For me, I try to use the international evidence, provide some footnotes about evidence, about real effect. Okay, I will start with international evidence, then I'm going to use a country have a very interesting phenomenon in terms of financial inclusions, less financial development, as the Secretary already mentioned, unbankings, and most population don't have any credit score. And the credit market is very segmented, and legal enforcement institutions are bad, are poor, I put it this way. It's China. So in the past few years, also use private data from the biggest Chinese e-commerce company called Alibaba Group. I try to introduce some of their business models and try to see how fintech lending might help the small medium firms' performance. So in the end, I will try to compare the difference between traditional bankings and fintech lendings if I have time. Okay, let me start it. So in this slide, we're working with Yongxin and the BI's team. We try to see dramatically increase in terms of fintech lending start from 2013 internationally, globally. By end of 17th, roughly $600 billion US. Okay, so red bar represents the normal fintech. In the top blue bars are those unicorns, big tech, big company like Amazon, Alibaba, all these kind of big e-commerce company. So rising dramatically. Then the second panel in the bottom, we try to differentiate across countries. Look at emerging market, look at developing country, look at US and UK. And if you look at the two countries nowadays are very important. If you look at the China in the middle, CN, and the red bar represent big tech. Blue bar represent the normal fintech. So you can see composition are different. In China, mainly through this big tech company. And if you look at the US, it's opposite. The big tech are smaller in terms of market share in the end of the right. And if you look at total fintech credit over GDP per capita, China roughly $291 compared to US 100. So people will ask the question, why China fintech is so in terms of size, so or in terms of growth so faster? So this paper we try to in the whole is a serious paper. We try to argue because we have a very bad underlying banking service, and a lot of remote area and a lot of poor rural area have a lack of financial banking support, and we want to see once technology can help the borrower, start to get lending from fintech, what's the benefit? So overall, we want to talk through the case from China. Maybe potentially give some suggestion and for the country and have some also the same issues. Okay, good. So as we know, small medium firm financing always have big problems. Finance constraint, roughly 40% of small medium firms are finance constrained. Based on our neighbor IFC's survey, the funding gap roughly 5.2 trillion. The need to finance those small medium firms. And why we focus on this small medium firm? Because in emerging market, low-income country, developing countries, those peoples have limited financing channels. Okay, why? Because number one, as I mentioned before, they don't have most of people. They don't have credit score. Okay, the lack of credit reference and banking also they have some very small skills, very opaque income statement. Sometimes they don't have financial statement, and no physical collateral, no house, no land, and no cars, and it's very hard to access traditional bankings. Okay, that's why a lot of people be classified as a traditional bank as high credit risk group. Okay, first one. Second one, because of a lot of place in developing countries, financial underbankings, bank branch is very expensive to extend to rural area, remote area. Okay, that's why it's very hard to access for some credit. So that's the question we're going to ask in this research, which is, can fintech lending help? Okay, what's a fintech lending? Fintech lending is a tech company like Amazon, Alibaba. They use informations about every single client, buyer, seller, consumer, or merchants. Okay, use all the information, more information, real-time information. Okay, so mention about the digital footprint. Then use machine learning algorithms, for example, simple random forest models. Create a credit score, use all the information, create a credit score. Based on credit score, they provide credit line. Okay, below, above the cutoff. Okay, so this is something different like traditional banking, and also think about everything's online. They're very cheap distribution channels. They don't have loan officers. Everything produced, also loan provide online. Okay, and the borrower, they don't need to put a piece of land as a collateral. Okay, this is a fintech lending we try to argue, or we try to study. So in the rest of my time, I try to argue what's the real effect. Once some merchants, small medium firm got credit, can fintech credit promote firm growth, such as from increase from sales growth? Number one question. Second question, can access fintech credit reduce sales volatilities? Okay, this second question. And due to my time constraint, I will not have enough time. I will argue what's new about fintech lendings. It's because of we have more information, or we have better models, like machine learning models. Okay, and on average, as I mentioned, use my case studies between China, also Argentina. This is it's a BIS working paper you can download online, to see the difference between cross countries. So delinquency is very low, less than 2%. And we want to see what's new about business model. It's because e-commerce platform, you have a platform benefit, you got a lot of information, and you can easily build up distribution channels or customer base or something else. Then remember at the beginning we mentioned all this kind of fintech lendings just through credit score, like a FICO score. Okay, use a company's internal credit score to provide credit. Classic question: hard information, soft information. They don't have loan officers. Why? The delinquency is so low. Okay, what's the new sort of platform? New form of collateral? Trust, reputations, or your activity online? Okay, it's a question mark. And finally, how to finance them? Whether this kind of a business model can extend to the rest of the countries or the rest of the world? Okay, can this kind of fintech lending can sustainable? Okay, most due to the financial frictions, due to some regulation constraint, in China, most of these kind of lending is through the ABS, asset-backed securities. Use underlying loans, go to the interbank market, issue the ABS, then you finance also underlying loans. And as we know, ABS market is very volatile. Then monetary policy, then regulation shocks might have a long-term impact to make this business model sustainable or not. So this is something we want to talk. But mainly, it's a long paper. You can take a look at more than 70 pages. But mainly today, I will talk about real effect. Okay, let me start it. So research, I use the data for R Financial. R Financial is an independent company, financial arm for Alibaba Group. So business divisions coming from, firstly, payment. They have Alipay. Every time you buy stuff, e-commerce platforms, you use payment. They have payment. They have wealth products. Okay, you can put your money to buy wealth products. And they have financings. They provide financing to small, medium firm, small business loans. Also provide financing to the consumers. And thirdly, they have insurance. Finally, they provide credit reference. Okay? In the past few years, they already served 8.5 million small, medium firms, accumulated microcredit loans more than 1 trillion RMB over $6 terms. And in total, they only have 377 employees, including management teams. Okay? So what's the business model? Business model is very simple. They have online platform called Taobao. Taobao is a C2C online platform for Alibaba Group, e-commerce, like Amazon's. And the market share is 82% online sales and 10% total sales online, offline. Our financial got information from Taobao because the same business group, a lot of equity sharing. And through all the information, they use, remember, also information for clients, person characteristic, trading performance, then create credit score. Based on their internal credit scores, they set up cutoff. In my research sample period, 2014, 2016, the cutoff was 480, roughly FICO 600. Based on the cutoff, they provide credit line to the merchants. Okay? One day, once I log into my Taobao account, I'll receive a message. Oh, dear Professor Huang, you do very well. You sell Swiss cheese, performs good. Now you're entitled credit line. The maximum credit line is 1 million RMB, and the interest rate, annualized, on average, 60%. Okay, and the maturities 6 months to 1 year, to 1 year, and this is a loan contract. Then I can look at the standard loan contract to see also consequent if I don't pay on time. Then it's 3 minutes in terms of filling the application forms. And one, I accept it because, it might be Chinese Black Fridays. I need to build up my inventory. I need to borrow money. So I click yes. So all 1 million RMB credit within 1 minute or 1 second into my Alipay account. Whole loan allocations process without any human interventions. And again, compared to another P2P lending in China, non-securitized interest rate, 60% annualized is very low. Usually in China it's double. Okay, so this is all business model. So if you look at the distribution of credit score, the red bar represent, and the X side is the credit score from 360 to 700. Is red bar represent some merchants' access of financial credit. The blue bar represent so merchants cannot access our financial credit. And for academic research, we'll look at the cutoff. Cutoff here is 480s. Look at the shadow part. We'll compare below 480, above 480s, like twins who got correct access, who didn't get correct access, and what happened to performance. This is what we want to show the relationship. Access fintech credit for the red bars below above 480. Like look at between 460 to 500. It's very similar. One merchant got credit, another merchant didn't get credit. And what happened to the performance? Fintech credit. What happened to the real effect? There was a real effect. Okay. So false evidence. If you look at the fintech credit, look at the sales growth, you can see below above 480, it can jump. So cut off like a FICO 600. Average sales growth of fintech credit access is probably increase 3% of the second month. If you look at transaction levels, transaction growth, also below above 480s, is a cutoff. The transaction growth of fintech credit increase in terms of 3% after the second month. So this is the first evidence I want to show is fintech lending promote from growth in terms of sales. Okay. Second evidence, a lot of merchants, small, medium firms worry about volatilities. Okay. So that's why we want to argue whether access credit increase, decrease volatilities. How to measure volatilities? We have a new data about weekly data about sales. We calculate the monthly sales volatility in terms of volume and in terms of quantities. We'll look at first month, second month, third month, 3 months later. So this chart shows in the left-hand panels, you look at the sales value growth volatilities. Below about 480, look at this jump, the decrease, the volatility, sales volatility for first month, second month, third month. In the right-hand side is look at the sales quantity volatilities, the numbers. You can see also decline below above the cutoff. Okay? So overall, we want to argue, look, access fintech credit reduce sales volatilities. Okay? So for short-term and long-terms. Due to my time, I don't have time to go through all the channels. We'll look at monetary policy shock, whether this kind of result is more countercyclical or not. We'll look at contract enforcement, legal systems. Okay? Whether, fintech credit can overcome traditional banking, because traditional banking is the area, the pool protections, and bank of other finance providers willing to lend to the small medium guys because debt collections, recovery rate is lower. That's why fintech credit can remedy use of machine learning, big data, try to remedy this kind of pool legal enforcement. Okay, contract enforcement with new technologies in monitoring and enforcement. Okay, in the end, we try to look at national disaster shock to see the causalities. Okay, so due to time, let me go through the end. Fintech company like big tech e-commerce company provide a credit line to these merchants based on much big data and more information, big data algorithms based on credit scores. And we do find out the real effect increase, fintech lending increase from growth and reduce from volatilities. A lot of channel can argue, and also firm with fintech credit are less likely to go bankruptcy and exit business because we know entry exit matters. When they access fintech credit, you reduce the firm access to the business. Okay. Finally, let me conclude. So what's new here? So I have a very simple chart to compare the fintech lending and the traditional bankings. If you look at the top bar, we look at the sales performance. So e-commerce platforms, so they know all the merchants, all the performance, sales performance, non-sales performance, and the ratings, the trust, the rating from the customer to the merchants, more information. Also, they know person characteristic. They can use a very cheap online lending network to lend all these kind of people who need credit. And also, we try to argue information advantage are major driver for fintech growth. Again, also, we know how to use credit. We know they put the inventory, the advertising, promotions. We know how to use the credit and who's the winner, who's the loser in terms of market competitions. And finally, I want to argue, since this kind of lending, fintech lending without any collateral, So what's the new form of collateral? Think about if I default at the platforms, all my payments might be freezes, and they know my suppliers, they know also this kind of supply chain finance, and they know my social network. So a lot of all my activities, my reputations are the new form of collateral. And thank you. Merci.
Our policy discussion Melissa will tell us her views.
Hi, good afternoon, everybody. I have to tell you, I feel like a kid in a candy shop, getting to spend a fair bit of time reading in depth these different research endeavors, the papers, and then thinking about how to bring this back to a U.S. policy audience and discussion. So it's a pleasure to be with you, and big thanks to the FDIC and their ongoing commitment to bringing research to policy. It's a critical need, especially as we think about the evolution and the adoption of data and technology in our financial systems. I don't have a deck, and I am going to try to go quickly because I know we're running behind, so I'm talking a little fast. But I do have a lot of things to share in terms of how I read and reviewed and think about the insights that are coming from this research. A little bit of context. You heard I'm with FinRegLab. We are a nonprofit, non-advocacy research organization. And part of the reason I'm standing up here talking to you today is because we are actually deep ourselves into empirical research evaluating cash flow data in underwriting of both consumers and small businesses. And that research will be coming out this spring. So keep an eye out for it. Bringing this back to the policy conversation, part of what I want to anchor us around are not only sort of our laws and regulations as it relates to thinking about technology and data in the financial system, but really importantly also keeping in mind that we have policy aspirations. In this country, we have 40 million individuals who are either deemed thin file, insufficient credit history to effectively evaluate them for credit, or they are thin file. 26 million of that 45 are actually no file. There's no credit record to effectively evaluate their credit riskiness. And that's both an important matter for the lender who's extending credit, but also importantly for thinking about prudent access to credit on the consumer side, too. We also have 15 million sole proprietors in the U.S. Everybody knows how important access to credit is for small businesses looking to grow. And so this conversation and this research that's really trying to dig deep and understand new types of data in evaluating credit risk are all very important for us in the U.S. context. I'm going to talk at the end about some of the very specific policy and legal issues that we all are going to need to think hard about and grapple with. But between now and then, I'm going to talk a little bit about some of the insights from the research that I think have real relevance for us here in the U.S. As you heard each of the each of the panelists talk, there are a range of policy issues that are covered, from housing policy, as well as obviously market competition when we think about global competition, big technology companies, not to mention the fintech companies, which many of us tend to think a lot about, that have to be thought about. I'm going to start off by sharing some of my reactions to Huang's research, because I think looking at this global set of implications of big tech, not just, no offense to you little fintechs, but the really big technology companies who are making inroads either directly as providers of financial services themselves or in partnership with others are a critical aspect of sort of the policy considerations that we've all got to grapple with going forward. So it's worth calling out, and he does in his paper, that globally big technology companies are currently the largest companies in the world by market capitalization, with the largest 6 technology companies all surpassing the largest systemically important financial institutions, GSIFIs. The report that they produced do a really nice job of helping to evaluate what are the circumstances that are driving big tech into offering financial products and services. But before I talk about those, I just want to, again, set some context for us in the U.S. Among U.S. big technology companies in financial services, Amazon loaned $3 billion across 20,000 small businesses in the U.S., the U.K., and Japan. That's in comparison to My Bank in China, which is an Alibaba subsidiary, also offering small business loans, which has loaned over 1.9 trillion yen, which is about $178 billion from its inception to 2018. So again, those numbers are remarkably different. 3 billion Amazon small business lending, 178.5 billion by My Bank. Yi and his team do a really nice job of looking across the globe to assess the movement of big tech in finance, and they offer up some really useful insights about why we see in certain geographies this real development of big tech in finance. Those areas include regulation on the fintech in general and big tech in particular. Regulations in those markets are more liberal in jurisdictions where banking regulation is more liberal. So generally a more liberal stance both on bank and non-banks in finance. Second, big tech credit sees a boost from easier financial regulation and also increased banking concentration in those geographies. Third, often big tech firms are charging lower fees than the incumbent providers and are operating with lower margins. And you heard Yi talk about how that's happening in practice with the platforms. And then fourth, the provision of credit lines and other services to small vendors is generally done without human intervention. And we all realize the costs associated with the humanness in extending credit. And in light of those regulatory and market insights, they did narrow down and they found that there are specific geographies where big tech with a big role in finance have really shaped up, and those include the countries of Argentina, Brazil, and China. Yi and his team go on to undertake an empirical evaluation of small business lending, both by Ant Financial, which Yi talked about, and also Mercado Libre, which is located in Argentina. And I just want to call out what I think are helpful insights from the research they did there. There are three main insights. One, they did find that big tech's credit access does generally appear to be helping small businesses or SMEs access credit where they otherwise would have been turned down. As shown in their paper, 30% of the small business portfolio originated by Mercado Libre would fall into the high-risk category under traditional incumbent evaluation of credit. Two, they found that credit access provided by big technology companies is actually creating productive developments or productive outcomes for the small businesses. The SMEs who are identified as eligible for credit and that took the credit when defined as eligible actually are seeing or saw the number of the products that they offered rise by 71 to 73 percentage points more than it had been in the prior year. In addition, these borrowers saw that the value of the products that they were selling increased by 75 to 79 percentage points. There's also a really interesting note, which may cut both ways. The research shows that firms that were found to be eligible for credit, but actually chose not to use the credit under these models, were actually seeing very similar results. Output, production increases, and also the value of the products that were being sold increases. And so it creates an interesting question of, is this really about the availability of credit, or is it something more organic to the firms themselves that are being evaluated? And then the third finding from Yi's work actually speaks to, and you talked about this, but it speaks to the big tech credit and how that may actually be enabling these small businesses to control sales volatility. And I think that's sort of somewhat obvious in terms of why that would be the case. While the authors do note there is difficulty in identifying causal relationship between the credit deliverance and the firm's performance, the findings do suggest that credit provision is helping small businesses and even micro businesses function and even thrive, and it appears to result in extension of credit to certain businesses, again, who otherwise would have been turned down. So importantly, and I think all of us are itching to understand more, what are the data that are actually being used? I didn't find these data to be especially surprising, Yi, but over lunch maybe there might be more you can share. But the type of data that is being evaluated includes things like transaction level data, sales volume, average sell prices, reputational information, as well as industry-specific characteristics and macroeconomic trends. So there are a lot of important questions that I'm not going to go into that relate to the dominance of big tech, the platforms that they're using, the risk of oligopolistic or monopolistic pricing behavior that all need to be thought about and contended with. I want to keep my focus most generally across the research to think about the data implications. Importantly, will this data from the e-commerce platforms and the machine learning algorithms that these firms are using outperform traditional metrics over the life cycle? We're at a high point in the credit life cycle. How do these data perform over the long term? It's an itching, pressing question we all need that answer to. Would the norm that if you're a small business and you're looking to access credit, and in your geography or in your market where you go to get credit are these large big tech platforms, does the norm become you have to give to get? I think that's an important piece of this. And importantly, whether consumer or even in the small business space, who's actually getting credit? I mean, this research is helping us understand where we may see extensions to credit, but do we also see potential implications of disparate impact types of risk? So I now want to turn to Manju and her work. I love this. I've had conversations with my kids about your research, which you'll hear about in a moment. But to highlight, they use more than 250,000 observations from a German e-commerce site to extend credit to consumers for goods purchased online. And the researchers were able to show that easily accessible information about consumers and our digital footprints were equal to or exceeded the information content of the credit bureaus. Big exclamation point there. You heard what the variables are: device type, operating system, channel, do not track, on or off, email, name in the email, number in my email. I have those lowercase. I do that all the time. These apparently matter, and we should all, frankly, be paying attention, and I will be. I was going to offer, I don't know if Amaya Garrity is in the room yet. He's on later on today. We actually had a conversation 5 years ago. I will not tell you which one of us went which way, but we had a debate. One of us uses Apple because we like to pay for our privacy. The other said, you know what, I'm using Google and I know I'm giving it away and I like getting it free. I wonder, how much of the self-awareness about the implications of things like what system are we using or what email address are we using, will that change consumer behavior? You did a nice job of talking about that. So what did the data evaluation find? This data is good. In fact, correlation between score based on digital footprint variables and FICO variables is actually different, meaningfully different. There's only about a 10% correlation in the data, the digital footprint data and the FICO data. Hence, the idea that these are very complementary types of data sets is something to pay attention to. FICO plus the digital footprint data gives us a 73% or 5.3 percentage point higher area under the curve in the model. That's meaningful. You heard all the data points, so I'm not going to tick them off. Read the report. Talk to Manju. I just want to talk a little bit about main considerations. The obvious question, what do we think about this type of data being used? I personally, as a middle-aged woman, and most of you all are pretty much middle-aged, I'm sort of mixed on this. It's really, in many ways, I don't quite think we'll set the policy, we will dialogue about what the right policy is, but it's about also what the next generation thinks and believes and feels is valuable in terms of what data they're sharing. I conducted an electronic poll this morning because I wanted to understand that next generation's point of view. So I sent a text to my 3 sons this morning, 2 13-year-olds and a 10-year-old, and I asked, would you be okay if, whether you spelled your name correctly when typing it online, it affected how much you were going to pay for that game that you wanted to buy? And 2 of the 3 said yes. They're happy to go ahead and give it away, whether they type their name correctly or not. You get the point. We are having to push ourselves to think about what are the norms, how are consumers going to be moving with their feet, whether we like it or not, and how are we setting the rules of the road in terms of what's allowed. Clearly, the variables in the research, proxy for income, that's one of the categories. Important question, do they proxy for protected classes? All right, I have 2 minutes. Richard, elegant research, nicely done. I'm just going to go ahead and call out the 2 areas that I feel like it would be helpful to dig into further, because your research really is quite dynamic and instructive in terms of trying to control for price differences. One of the questions that I would pose is, we've seen with the other researchers that there is a lot of value in non-credit history data, non-credit score data. And if we're predicating the ability to credit risk assess, especially LMI populations, minority populations, based on a FICO score, is the FICO sufficient? And so even the sort of predicating on the FICO, which is essentially what constitutes the GSC's pricing grid, what are we missing by doing that? I think there are also really important questions, and you speak to this somewhat in the paper, about other costs that are not anticipated outside of what you would sort of accept under the pricing grid. You talk about servicing quite a bit in the paper. I think that's excellent. There are many other costs that would have to be thought about as well, fraud and others. I'm out of time. We're going to need 5 minutes. So let me be kind and just get to some of the things that I know that we're all thinking about hard now as I wrap up. First takeaway, the research papers today suggest this non-traditional, non-FICO data may be helpful in accurately credit risk assessing both consumers and small businesses. Important note in all of this, and it will be true for our research as well, we're really only looking at short-term credit. Not only do we need to know what it looks like through a down cycle, we need to know what longer-term asset classes this data means for those. Second, across all the studies, the research is showing that data-driven, computerized, algorithmic, non-face-to-face lending appears to be resulting in expanded financial access to populations and borrowers who might have otherwise not been able to access credit. Is it time for you policymakers to rethink what type of data do we want to support and enable in our underwriting models and systems? Third, we really do still need to evaluate the data for disparate impact implications and have some really important conversations about the trade-offs of expanded access to credit to populations who otherwise would have been turned down against what the risks are that we continue to see differences between white men and everybody else. How do we really sort of think about that? Not just from a legal standpoint, but from a policy standpoint as we think about the potential advantages of bringing in this data. And then to wrap up, I just want to quickly tick through the range of regulatory and policy questions that are raised by the use of non-credit. Most fundamental question is the accuracy of the data in predicting credit risk. This research suggests that, at least in the short term, we can see some confidence in the accuracy. Obviously, fair and inclusive access considerations are critical. Third, Data privacy, accuracy, and transparency, these are the principles that undergird the Fair Credit Reporting Act. How do we ensure those expectations and those principles as we're contemplating vast new types of data in underwriting? There's a big debate that's happening around, do we modernize FCRA or do we do away with it and think about whole cloth, some new architecture, policy architecture that governs what data is being used in financial services? That's a really important topic for all of us to think about. And then fourth, a critical question is really around consumer data consent and control. How do we make consumer permissioning meaningful? How can we practically vest consumers with enough insights and visibility and control over their data? And how do we think about putting those responsibility and ultimately liability expectations on the ecosystem? Who's going to be sitting with those responsibilities? And then I'll just leave it with, how do market players manage security and access issues? The Gramm-Leach-Bliley Act applies broadly, but not all players are subject to the same level of practical scrutability. Significant advantages and risks to the current way in which data is generated, data is pulled, data is transmitted, data is then retransmitted, and there is a real lack of clarity of who's on the hook. And is it going to end up being the consumers, or are we going to start to figure this out? Because we actually believe there are real advantages to bringing in new types of data into our underwriting systems. I'll leave it there. Thanks, everybody. And good job, researchers.
Time for some questions. Please step up to the mic if you have a question for any of the authors or the discussant. I don't think that mic's on, is it?
Can you hear me? All right. So Didi here from Capital One again. I had actually a two-part question. So totally agree and understand how the new data set is allowing access to the unbanked. Have you guys seen a sort of a comprehensive swap-in, swap-out analysis, meaning like as these data sets are on one hand allowing some of the unbanked people access to credit, on the other hand, is there a chance that they're also leaving out, because you've added this new data element, they're leaving out people? So is there a sort of a comprehensive sort of swap-in, swap-out analysis done? The second part is, like, one thing that, like, as I look through this sort of, been multiple presentations where we talk about, alternate data, one thing that kind of bothers me is a lot of the modeling, underwriting modeling that has been done on alternative data, things like digital data, has been done in a very benign credit environment. So the last sort of 6, 7, 8 years. My hypothesis is just like credit behavior changes in an economic downturn, so does digital behavior. How do you think these models would take into account sort of a different digital behavior down the road when there is a downturn?
Okay, so the first question, right, was on the swap in, swap out. And so here's the thing. People who don't have credit bureau scores typically do not have access to formal capital markets. And what we're finding is, some people who didn't have it now have access. So that's a good thing. Now, the other part is, you're getting better predictive power, which means you have to be denying poor credit, right? And so you might have had a good credit bureau score, but if your footprint is saying you're not so good, you're misspelling and all this, then you get denied credit, and, that's working well. So any good credit model, right, you're going to deny more people and accept more people and improve default. So I think the same thing holds for digital footprint. how will digital footprints work in downturns? I think that's a good question. I think that's preceded by the question of how a digital footprint is going to work in the long run. Because one, as we get aware of them, we should expect people will game them. If you think the model that held last year is going to hold this year, you're deluded, right? It has to be dynamic. It has to change. Second, suppose you're a firm that's making something that is of poor quality as judged by the digital footprint. You may see change in behavior there too. So I think it's the good thing about the traditional credit bureau scores, whatever, it's a tried and tested system. We know what we're getting. Digital footprint, it's not. And the problem is behavior on all sides. So it's the consumer can change behavior, but the firms can change behavior. The regulators can change the. So I think all of that makes it much, much more complicated.
Other questions? So I guess I'll ask a question. Manju, if lenders were to adopt digital footprints either alone or in combination with credit scores as an input to their credit underwriting process, what do you think this would do in terms of the level of discrimination against minorities and immigrants and others who are currently, that we know are being discriminated against under the current system? And what policies might we adopt to minimize the amount of discrimination that comes about?
I think that's a big question, and we should have Richard also coming in on this. I think so when we're looking at digital footprint, at least the way we had it, our 10 variables, there's nothing explicitly correlating with minorities or race, etc. That doesn't mean there can't be a latent correlation, right? And so once you take away, the variables that are okay, it might well be like shopping at 2 a.m. It might be the person who has the night shift. Right. And, that might be disproportionately a minority. And so, yes, that can happen. And from a regulatory point of view, you would be asked to orthogonalize all those variables and find the residual correlation. I think firms right now are just worried about getting the right model so that they don't go bankrupt, right? And so the first order of business is, can we get the right credit model? Once you have that in place, then I think you start worrying about, fair lending, etc. I think trying to do it all simultaneously, and I think as the policy panel earlier suggested, you don't want to constrain innovation either, right? And so, you have to be very, very careful here because there is a search as to, what is right, can we really predict default? And so, all that takes some time and energy. And that doesn't mean we shouldn't be concerned about these issues. Clearly, we should be. But in a market where this model is continuously evolving, how do you lay down rules? And so it's tricky.
Can I add?
Do you have anything to add, Richard?
Sorry, Richard.
I just want. I think Manju said very eloquently sort of what some of the issues are. I think I maybe don't agree 100% that we can leave consideration of these things until later. I think a lot of the variables that we're looking at, when you compare them with the standard variables that we would use in a credit scoring model, it's much more obvious why those variables are there. And so in a sense, sort of their inclusion is a more benign act. And if there is some sort of peripheral discriminatory effect of those variables, we can deal with that later on, but the variables we're using have a sort of an ex ante obvious reason for being there. I think a lot of these variables we can come after the fact and sort of tell a story about why they're relevant, but they're not. A lot of them are not. They're not the variables that you would think of as they're not obviously correlated with credit risk, and therefore it does seem to me that there's a bit more of an onus on the user of those variables to make sure that they don't induce disparate impact before you start using them.
Did you have something?
Yeah, I was going to add on just from a really practical standpoint. I think one, This is in part why the research we're looking at is still financial data. You can see a lot in a bank account. You can see behavior. You can see transaction inflow, outflow information. But I think there is some value to prudently tiptoeing our way into both, do the data hold up, do the models work, do we see risks of disparate impact in the data that we use. And I would even call out FICO has built Ultra FICO. There's probably somebody here from there, but they are also setting that up right now as a second chance structure whereby somebody gets to opt in if they're not making it in under an existing threshold, FICO threshold. Then this is an option for them to potentially get another look where then additional data is being brought in. So I think that there are some really careful and thoughtful ways that we both should think about how we're making our way into looking at non-credit history data, how we're evaluating it from a research standpoint, and how industry itself is being really practical and rational about rolling this out to consumers and small businesses.
One more question.
Hello. Diego Zuluaga from the Cato Institute. I had a specific question for Richard first. Did you find discrimination in the cross-section of firms that you looked at? I know you segmented it by fintech versus non-fintech and so on. Or was it intra-firm discrimination? I'm thinking here about the composition of customers within firms that are lending mortgages in particular areas. And then a policy question for the panel as a whole, which is, how should we handle the trade-off between an environment in which we keep finding some residual that is apparently discrimination, but increasingly we're allowing access to more and more people, particularly minorities and low-income people, versus preventing discrimination as much as we can, but risking that we won't increase access as fast? Thank you.
Okay, I'll take the first one. So the initial results, the 7.92 basis points, that looks across all firms, but doesn't sort of look within firms. But we do a within firm analysis as well. So we control for the identity of the individual firms as well as the geography. So it's sort of firm and area. And that really does it reduces the number very slightly, but the overall effect is very similar.
I think at least for the data that we are looking at, right, I guess we're focusing more on the positive side, and that is people who do not have credit bureau scores, who do not have access to formal credit markets. Can we give them access with the digital footprint? And the answer is yes. So that part, is the positive part. Nothing in our bare bones variables, there is no variable that is obviously correlated with minorities or other things. Now, that doesn't mean that if you had enough data and you weeded everything out, that there may or may not be a residual correlation, but that's, at this point, that would be very hard to know.
Okay, please join me in thanking all of our panelists.
Okay, yes, thank you, Robin, Manju, Richard E., and Melissa very much for sharing your insights. It's time to break for lunch now. I want to point out Christine Davis over here. She's our conference organizer. She's going to direct traffic here a little bit for us and let you know when it's time for your table to go out and line up at the buffet. Take it away, Christine.
Thank you, Diane.
I promise there'll be plenty of food and time to eat before Chairman McWilliams comes back.
Yes.
Plenty of food.
Thank you all. If you all could remain seated for just a little bit, indulge me for a second. We have 3 double-sided buffets outside, so we can accept 6 lines at a time. So if you have on your table words or phrase or reserved, please get up, help yourselves out of both doors, and we can take maybe 10 tables at a time, so it'll go quickly. Thank you.